Hey everyone, welcome back to Corporate Decoder. Today we are diving into a filing from REZOLVE AI, and let me tell you, it's a wild ride. It's got twists, turns, and enough financial jargon to make your head spin. But don't worry, we will decode everything. And before we get started, if you're looking for deep dives into corporate documents, then make sure to subscribe. We also have a Discord community linked in the description below, so check it out. So what's this report about? Basically, REZOLVE is trying to get the go-ahead to issue and resell a whole bunch of shares. We're talking millions of shares here, and that could have a big impact on the stock price, so buckle up. This isn't a brand new thing, but rather an update to their existing filing. They're adding the latest financial details, specifically from their annual report. Now, they are using a shelf registration, which is a fancy term for saying that they might offer these securities at any time. It's like they have a shelf full of shares and warrants ready to go whenever they see the right opportunity, or they need some cash. It's a flexible approach, but it also means things could change quickly. Of course, this wouldn't be a proper filing without a big chunk dedicated to risk factors. So what's keeping the folks at REZOLVE up at night? Well, pretty much everything you can imagine. First off, they haven't been making much money, they depend on partnerships, and there's no guarantee those partnerships will stick around. And to make matters more interesting, they have a history of losing money, and that's expected to continue. REZOLVE warns they expect to incur significant expenses and continuing losses for the foreseeable future. That's not exactly a comforting statement for investors. And it's not just them, the world economy is not on their side. Factors like inflation and global uncertainty could throw a wrench into their plans. Basically, if people start holding back on spending, REZOLVE's SMB clients might be disproportionately affected by economic downturns. Growth is tied to third parties, including partners like Microsoft and Google. If those relationships go south, REZOLVE could be in trouble. They don't own these relationships, and nothing says that they can't just walk away from REZOLVE. And finally, as with any tech company, if their platform isn't up to snuff or has glitches, that could seriously hurt their reputation and their bottom line. As you can see, REZOLVE faces a whole host of challenges, which sounds like most startup companies. Let's move on to the offering. This is where they lay out exactly what they're planning to do with these securities. First, they're registering the potential issuance of almost 7.5 million ordinary shares. These are tied to something called public warrants, which give the warrant holder the right to buy shares at $11.15 each. If everyone decided to exercise these warrants and pay the cash, REZOLVE could get roughly $86 million. But there is a catch. What they're really focused on is reselling a whopping 156 million ordinary shares. These are being offered by something called the selling holders. This could be investors who got in early, executives, or other key stakeholders. So where is that cash going? Not to REZOLVE. Because they're registering the resales by existing shareholders in the company, they would not get any proceeds from this sell-off. So if these guys were to start dumping shares, the stock price would go through the floor. Now let's talk financials, shall we? If there's one part of these filings that everyone cares about, it's the numbers. Let's see if the raw data confirms or contradicts that story REZOLVE is trying to tell. And they have a couple big acquisitions, Blue Dot and Group Buy. They both are now baked into their numbers. Let's see how it works. Taking a quick glance at their pro forma condensed combined balance sheet, a few things jump out. Cash and cash equivalents, 16 times $2 million, which sounds like a decent amount, if it weren't for the fact that their total shareholders deficit is a negative $29 million. Negative shareholders equity means that the company owes more than it actually owns. Ouch. They are essentially trying to buy their way out of this situation by purchasing these companies, but all they are doing is digging themselves deeper into debt. The only way for these acquisitions to make sense is if it causes a massive explosive growth in the revenue of the company. To add insult to injury, the Group Buy and the Blue Dot acquisitions increase costs. Jumping over to the income statement, you see the same sorry picture. Even with the additional revenues from the combined companies, their operating loss is still $152 million. So far, not seeing Warren Buffett numbers here, which would require more scrutiny to really uncover what could happen or not in the future. Now that we've looked at the financials, let's see what management has to say. This section is essentially their spin on the numbers. Did they do well or didn't they? Well, they certainly don't start off strong. They basically said they have not been making much money and there's no guarantee that they will be able to attract new merchants and increase sales to new merchants and increase sales to new merchants. And if that were not enough, they also warned of the impact of worldwide economic conditions. Overall, a pretty sorry set of predictions that have to have numbers on their side to back up. And finally, to cap it all off, there's that dreaded paragraph about going concern. Basically, it is an assessment of whether they can stay in business. If they can't convince an auditor that they can make it another year, investors get spooked. And what is their take? Not good, and they add a list of things they need to do to survive, including securing new capital, generating revenue, and cutting costs. For now, let's transition from the numbers to who is actually running the show. The main man is still the founder and chief executive officer. And as with many companies, there's a number of executive and non-executive directors. And now what is interesting, scrolling down the page, you can find basically there's a number of rules that make it so hostile takeovers are not possible. That's all right. So what's my take on all of this? It's a mixed bag, to say the least. I'm concerned about how little their current revenue figures are. While all startups have difficulties, that revenue figure is scary. The best thing that the company has that most startups can't even dream of is massive partnerships. This is their strength. A lot of people and small businesses already use these channels. If Resolve can provide a compelling offering, it has the potential to take off and get them out of their debt hole. However, the debt load is a massive weakness. If they can't start generating cash and those partnerships don't pan out, it might be game over. It all comes down to execution. Alright, that's our breakdown of Resolve's latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.